Hello, I'm Michael Johnson at the law firm of Maynard Cooper Gale, and I'm here to talk about seed financing. Specifically, I'm here to talk about convertible notes and safes, or simple agreements for future equity. In this discussion, we will learn the differences between the two and how they could be useful for you raising money for your startup company. As an early stage investor, you typically have very little revenue or capital to spend on raising capital. And so it's important that you have vehicles that you can utilize that will allow you to access capital markets that have a low barrier of entry. Typically, when you go to look for investors, you're looking at a couple of groups. One is which you'll be venture capital groups, or more likely it'll be angel investors or friends and family. Most seed rounds are somewhere around $50,000 to $2 million, and therefore they're not very large rounds in the grand scheme of things. And so in doing that, what you don't want to have happen is you don't want to have to prepare a full-blown offering or a private placement memorandum with a bunch of disclosures and other documents related to it in order to get access to $50,000, $100,000, or $200,000. That's where convertible notes and safes come in. These instruments allow you, or effectively help you pre-sale equity in your next round of financing, your preferred round of financing, or potentially a common round of financing at low cost. And and those instruments have a conversion feature that allow you to take the dollars that have been pre-sold and convert them into the round at some discounts and valuation caps, as we'll discuss earlier. First, we're going to discuss convertible notes. Convertible notes have been around for a long time and have typically been the staple of what I call the pre-sale of a preferred stock round. Convertible notes are just that. They're a debt instrument. They're a note, a promissory note. Typically, that note's unsecured. It has a fixed rate of interest, and it also has a conversion feature related to it. It does have a maturity date to it, just like any other note. And so effectively, what that note would say is you would have the ability at some next level of financing to convert that note into the round of equity at a certain price. The goal is basically to convert the holder of the note into the round of equity and make it what we call in the legal world pari passu, which means the same as the other investors that have bought into that round. The interest rate is typically an incentive to get that investor to bear the risk of coming in at the early stages. To remember, these are people that are coming in pre-preferred stock round. So these people are really early on investors. Typically, the amount of these offerings are $1 million or less, but we have seen some in a more sophisticated startup. We have seen some pretty sizable convertible note rounds. The conversion mechanics are fairly simple in that if the note holder is holding a note at the time that there's a next equity conversion or a next round of financing that meets a certain threshold, typically there's a dollar value attached, $5 million raised in the next round. That note, along with the interest that's accrued and the principal of that note, would convert into the next round of equity at the price designated in the next round, less a certain discount or evaluation cap, which we'll talk about in a minute. If the note doesn't convert before maturity, typically the note holder has the option to take his money back plus the interest, or he has the right to convert it into another equity such as common stock, or he can he could refinance the note and hold it and move it and sit on it until the next preferred round. If there's a change of control, which rarely happens but could happen, there is a payback based on the discounted price. And sometimes there's even features built in there that allows them to get a certain stated return on that note for instead of converting in the acquisition. The first thing we want to talk about that's unique to a convertible note is a discount. And the discount is merely what you would think it is. It's a discount off the price of the next round of equity. That discount typically runs from 10 to 30%, but most are about 20%. That's what we normally see. In addition to that, there's a valuation cap. And what the valuation cap is essentially a cap on the valuation of the company at the time of the offering of the preferred stock round. So if you're, for example, simple example is if your company is worth 15 million and you're raising at a $15 million pre-money valuation, there may be a valuation cap in the note that says that that valuation is capped at 10 million. And so the calculation to move the convertible note into that round would be used at that valuation cap. Typically, the discount and the valuation cap is an either-or mechanism in that you get the lesser of the discount or the valuation cap when you're converting. Know that everything is negotiable, and sometimes in some rare cases you have both, but typically it's either one or the other. Now compare convertible notes to safes. Safes are a unique animal in that it was it's essentially an agreement that was created by this accelerator in San Francisco called Y Combinator. And Y Combinator is sort of the preeminent accelerator in the United States. And so they created this investment to reduce the barrier to getting angels and friends and family, and sometimes even VC, into a startup company. And it's intended to move money quickly and at a low cost into the company so that you can help the company grow at a faster rate. Safes are, like I said, fairly new to the scene. And effectively what it is, it's just a contract, like an option, so to speak, to buy equity in the next round, in the next preferred stock round. Safes have some quirky features in that they're not really a, Y Combinator will tell you they're not really a security and they're not really debt. There is a question in my mind whether they are a security, but they have a lot of the conversion features of a convertible note. And they do have a very simplistic structure to them. The safe, unlike the convertible note, doesn't really have a maturity date. It's not a debt instrument. It's also it's not accruing interest. So, all it really says is that, we have an agreement. We're going to buy that. I will buy equity at a conversion price whenever you raise that equity. It does have a valuation cap, and it will include a discount sometimes, just like a convertible note. And so it does have also a feature that if you do sell the company before the safe is completed, that it would convert into some either convert at the conversion using the conversion formula to get into the deal, or have a payback feature to it. Depending on what you decide is best for your company, safes and convertible notes have some strengths and weaknesses. Here on this slide, we've laid out a couple of them just generally. Know that both of these instruments are very common and used a lot by startups. I would say that the safe sometimes is abused in the market, in that it's probably used in situations where it really shouldn't be, just because some people think it's just an easy way to collect money. What the intent was that safes would not necessarily require an offering attached to them. They would just simply sign a document and hand you a check. That's not necessarily been the case in the legal world. I think you'll find that if you do get a safe offering document, you're going to have a set of disclosures and a lot of information attached to it that essentially results in you having an offering document sitting in your lap. So I'm not sure the legal community is totally, for those that do a lot of offering work, is not attuned to the mantra that the Y Combinator has put out there, that this is just one simple document that's not really subject to some of the securities laws disclosures or the Reg D requirements that we typically see in this world. We want to talk about a couple of issues that are common with both documents that you need to be aware of as you look at making an investment like this. One of the biggest issues that we've seen are the conversion features relative to safes and to convertible debt. One of the pitfalls that most founders don't understand or don't really pay attention to is they don't really take into account the discount feature or the valuation cap feature when they're looking at their cap table, their pro forma cap table going into the next round. And so essentially what may happen is they go out and they may be overly successful in selling safes or selling convertible notes. And then they find out that, you know, there is a significant valuation discount sitting out there that effectively shifts a bunch of equity away from them over to the convertible note pool. And then so when they bring in the Series A round, they realize that, hey, I don't think I own 75% of my startup. I own 45% of my startup. And so if you don't model out and you're not aware as you go through your note offering or your safe offering in modeling out the valuation dilution and the discount dilution that's associated with those instruments, it could be a real shock to some when they go through and they model out their Series A. All those instruments convert into that Series A round, and now the cap table is not showing what you thought, or it doesn't meet the founder expectation. And so that could be a pretty significant issue with these. We always advise our clients that, you only want to take the money that you need to get you to the next round of financing. What you don't want to do is oversell a cheap round of equity. And sometimes that's easy to say sitting here when you have money and you're sacrificing to get your business off the ground. But that's something that certainly needs to be attuned. Founders need to be attuned to as they do these safe rounds and these convertible note rounds, so that they don't oversell them, they don't overpromise, and then at the when it comes time to do your first preferred stock round, there aren't any negative. The consequences, the dilution is not as great as you thought it was. We've added a couple of sample calculations that I won't run through here, but they'll be here for your edification when you need them. A couple of things that I also say about convertible notes. Understand that a convertible note is debt. And so when you look at your balance sheet, if you raise $1 million worth of convertible notes, you will have $1 million worth of unsecured debt on your books. And that debt will be accruing interest that has to be paid back if you don't make it to the next round of financing, a qualified round of financing in time. So you have to be mindful of that. And timing is important. Sometimes some sophisticated investors try to slip in penalty provisions where the valuation cap decreases or the discount increases if you don't meet or don't come out with an equity round in a time period that they think is feasible. Note that if you do get to the maturity date of a convertible note, you have to be careful, because at that point, then it's the investor's right to decide whether they want to get their money back plus the accrued interest, or extend that note or convert it into common stock. So that could put a company in a precarious situation. The other thing that I would note is, as on convertible notes, sometimes investors try to negotiate in a security feature, whether they try to take a security interest in the assets of the company. That can be pretty problematic for a startup, especially a company that is going to a more sophisticated round, a preferred stock round, looking for institutional investors. That could put a chill on your next round of financing. And honestly, venture capitalists coming in, they're not going to be very keen on investing in a company that essentially is beholden to its seed round investors through a convertible note round. So there's sort of a song and dance back and forth between investors and founders, and One thing we say here is that, there are not any wrong decisions when you're a startup. You do what you got to do to keep the company open. We just try to minimize the problems that could occur. And that's one of the reasons why we're doing this, is so that we could educate you and hopefully arm you with enough information so that when you do start negotiating your first round of capital, that some of these major pitfalls you've kind of planned for, and can make sure that there's no unforeseen circumstances coming through. Thank you, and I appreciate you listening.